It's time now for finance practice problems, questions, and answers. While a course in finance can be a bit daunting, a lot of math maybe, but remember, you're going to make the big bucks as a result. Let's start with something basic, and that is after tax. A person is in the 25% tax bracket, earns 12%. What is it after tax? It'd be 9%. Subtract a quarter from the 12, you got the 9. But what if he or she earns 7% in a tax-free municipal bond, no tax? Well, it would be the same before and after, still 7. Well, let's look at ratios. Probably the most important is return on assets and equity, and we got to do something the accountants don't normally do. Return on equity is the return on assets, that's a profit margin, times the turnover ratio. Notice the sales cancel. Then we're going to multiply times assets, so that cancels, and then divide by equity. And remember the accounting identity, assets equal liabilities plus equity. Well, let's say we have a firm that has $5,000 in assets, $2,000 in debt. Ooh, that means they have $3,000 in equity. Debt asset ratio is, 40%. That's the 2 over the 5. Sales were $25,000 with profits of $750. So if you figure it out, the profit margin is 3%. And the sales asset turnover ratio is 5 times. Well, if you multiply the profit margin times the turnover ratio, notice again the sales cancel. Well, that's 3% times 5 is 15% for the ROA. For the ROE, that's for the stockholders if you like, recalling that we have $3,000 in equity. Well, we're going to multiply times the 5 in assets and divide by the 3 in equity, getting 25% versus the ROA of 15%. And it's always the case the ROE will be equal or greater than the ROA. Let's do another one. Here we have a firm with a debt asset ratio of 1 to 2, profit margin of 6%, turnover ratio of 4. Again, for the ROA, just multiply the 2, get 24%. Now, in this case, we can add 1 to the debt equity ratio, so the ROE is 36%. Let's go to another place on the accounting statements, and again, we're going to do something the accountants don't do. Let's look to cash flow, and it's net income after tax plus depreciation. Another one is EBITDA. That's finding what the amounts are before the interest payments and tax and depreciation. Tells you what the front end of the business is doing. Here we're going to construct a mini income statement. We have sales of $300. All those paid cash costs are $100. And we have depreciation, a non-cash current item of $50. And we have interest expense of $30. We're going to pay tax on the net income of a quarter. Well, the earnings before interest and taxes would be that $300 minus the $100 minus that depreciation of $50, giving us $150. But wait, there's more. We're now going to subtract the interest expense of $30, making $120. Then we're going to take a quarter of that figure for the taxes. That's another $30. We wind up with $90. So we add back the depreciation, $50, $90, $140. And look at that. We can confirm that because, well, the cash flows coming out, that's a net of $200, and the 2 payments of the interest and taxes, another $60, leaves $140. For the EBITDA, we take that EBIT, $150, add the depreciation of $50, we get $200. Oh, by the way, look at the difference between the two, the $200 and the $140. That's $60. Where are they? $30 in the interest expense, $30 in the tax. Well, we're going to move on to present value, which is the discounting of cash flows. Present value is a reciprocal of the future value. And we have something called an annuity. We'll use a table here if you like. And we even have a perpetuity. That's the reciprocal of the discount rate. Let's look at a scenario of a payment of $5,000 at 6%. year 8 as a single sum, years 1 through 8 as an annuity, and forever at 6%. Well, for the single payment, we'd look at the table for a single sum that's always less than 1, and we get some $3,135. Annuity table, usually greater than 1 but less than number of years, we get $31,050. For the perpetuity, going on forever, we don't use the table, we divide by the discount rate. In this case, we get some $83,000 odd dollars, and we can check that because 6% of it gives back the $5,000. And of course, present values can be applied to something relevant, such as a discounted cash flow. Maybe you have monies coming in, monies going out. Let's take the present value of each of them. A firm earns $200 a year, has costs of $40 a year for 4 years, and the discount rate is 8%. Well, we'd first take the difference between the $200 of monies coming in, $40 of the monies going out, that's $160, and at 8%, well, that's the $160. We go to the table. Remember, this is a 4-year annuity. We get some $529. A more relevant place to use our tables is where they both come together. With a bond, you have an annuity payment of the interest payment stream and the final face value, usually 100, of the single sum. Let's do this one. We have a bond that pays 6%. We can use annual. Normally it's twice a year at half the amount, and matures in 7 years, and we want a 5% yield. Notice it pays more than what we want, so it trade at a premium. Recalling the bonds are always priced, calculated as a face value of 100, so the interest payment will be the interest rate. In this example, will be 6, and we can take an annuity table for those 7 years, and well, we get that amount of 34 plus the single sum. 71 adds to 105. Notice it does trade at a premium as expected. Projects, and let's say we have monies coming in. I've labeled it S here for sales, monies going out, C for costs. Got to do them after tax, and we'll discount them minus the initial outlay. Here we have a firm earning $200 a year, has cost of $40 a year for 40 years, tax rate of 1/4, and a pre-tax interest. We're going to make that after tax. Remember our very first question. That'll be 6%. Well, the money's coming in, 200 minus the 40 going out. That's 160. Tax rate's 1/4. So after tax, that's 120 a year. And, 6% discount rate. Annuity factor, $415. If the initial outlay is more than that $415, we'd reject it, and vice versa. Then, well, we did bonds. Let's do stocks. Well, the valuation would be the dividends coming in discounted, and the dividends are growing at some rate, say G, and that turns out to be the next period dividend divided by the difference between the discount rate and the growth rate. First version, we'll have a dividend being paid next year of $3, grows at 7%, discount rate's 13. Well, the difference between the 13 and 7% is 6%. Into the $3 gives us 50. But now, what if we had a stock that just paid a dividend of $4 a share? Then we'd have to adjust it for one more period of growth at 5%. That makes it $4.20, and we're going to discount it at 10%. Well, the difference between the 5 and 10% growth rates is 5%. Into the $4.20 gives us $84. You know, you probably have more than one project, and maybe you have to choose because you don't have enough money. First of all, if they are mutually exclusive, you can only do one, then you use NPV. If you can do multiples and you don't have enough money, you rank them by the internal rate of return. Here we got 3 projects, A, B, and C. Notice that A has the highest internal rate of return, and C has the highest net present value. Each project is 100, but we have 200, but we can only choose one, then we would go with C. If we have 200, but now we could choose among the 3, then we'd go with A and B with the highest internal rates of return. Now for a full-blown example, lease versus purchase. On a purchase, you have the tax savings from the depreciation plus salvage value minus the initial outlay. On a lease, you just have the negative payments after tax, noting they do occur one period earlier. So if you have a project making $200 a year, costs are $40, it's over 4 years, tax rate is a quarter, and the interest rate is 8%. Well, first of all, we're going to change that to 6%. We're calling the very first lesson. Purchase price is $120 with straight line depreciation. Made simpler here, amounting to $30 a year, no salvage value. Or we can lease it $80 a year, beginning of the period payments. What's the net present value of each? First of all, let's just look at the front end of the business regardless of whether we lease or purchase. Well, we'd have the $200 going in, $40 going out, that's $160. Tax is a quarter, so we keep 3/4 of that, that's $120. And the discount rate is now 6%. Thus, we get $415 regardless of whether it's a purchase or a lease. With a purchase, we have the initial outlay of $120, no adjustments, and we're going to add back the tax savings on the depreciation and take the present value of that. Well, that's $25.9 minus the $120 is a negative $94. Adding it to our front end of the business of $415, net present value $321 for the purchase. For the lease, we have $80 going out. Remember, it's after tax, so it's now $60. And we're going to multiply it times the annuity factor a year earlier plus 1, because it's now payments 0 through 3. Or equivalently, taking the 1 through 4 year factor and increasing it by 6%. Regardless, that's a negative minus $220. Net present value $195, that's the $415 minus the $220. Which do we choose? Sure, that purchase sure does look more profitable, but it is riskier. The lease is less risky. And those risks are business risk, interest rate risk, style changes, and obsolescence. Well, one of the cutting-edge theories in finance is the capital asset pricing model, which is the risk-free rate, say the Treasury bill, plus beta, that's a covariance divided by the variance, of the market premium above the risk-free rate. Here we have two examples, A and B. A has a beta of 3/4, actual return of 11. B has a beta of 1 1/4, actual return of 13. Risk-free rate is 4. Market return is 12. Market premium thus is 8. Well, for A, we take that 3/4 of the market premium of 8. That's 6 plus 4 make 10, but it achieved 11, so we accept it. B, on the other hand, 5/4 of that 8 premium is 10, plus 4 is 14. We reject it. Notice the higher one we rejected. Let's move on to the weighted average cost of capital. The weights of anything is totaling 1. Here we have the weight in debt times the cost of debt, plus the weight in equity, plus the cost of equity. Here we'll have $3,000 in debt, 5 in equity. That's a total of 8 of the assets. The weights, therefore, are 3/8 and 5/8. We have 8% in debt. Tax rate is a quarter, so that makes 6% on the debt. We have a 2 dividend stock, $50 price, growing at 6%. Well, the 6% plus the 4% on the dividend makes 10%. So we'll take 3/8 of the interest expense after tax, which is now 6, and 5/8 of the 10%, adding up to 8.5%. Let's do another one. Firm has a debt asset ratio of 2/3, tax rate of 1/3, interest rate is 9%, stock pays 6%. No growth. What's the weighted average cost of capital? Well, that debt asset ratio is the weight in debt, and the weight in equity, no preferred here, would then be the remainder of 1/3. That 2/3 times the interest payment of 9%, but it's after taxes now 6. Then we have 1/3 for the equity times 6%. Remember, the stock has no growth. We weight them together, and 6 and 6 has an average of 6. You might want to manage your cash, your inventory, even if it's just in time to tell you whether the pipe should be big or small, or little trucks or train loads. Well, it's the EOQ, and my mnemonic device is it's 2 times the usage transactions cost divided by the carrying cost, or King Tut overseas, taking the square root. This minimizes the total cost of carrying your inventory half the time, and plus the number of orders, that's usage divided by the quantity, times your transactions cost. Let's say a firm uses 10 grand a month. Remember, it's monthly, times 12 for the year. Transactions cost is $24, and interest rate is 9%. Well, we would have 2 times the 10 grand times 12 times the transactions cost of 24, divided by the interest rate of 9% as a decimal, and we take the square root and we get 8 grand. And that turns out to be about 15 times a year. And if we check the original equation, we'll find that's 360 plus 360. Notice those 2 terms are equal, verifying we did it correctly. Well, here's a relatively easy one. Break even. Well, let's see. Profits are revenue minus costs, fixed and variable. Set that equal to 0. Break even is the quantity, which is the fixed cost divided by the profit on each unit, price minus variable cost. Let's say we have fixed costs equal to 120 grand a year. Labor costs are 24 per hour. They make 3 units per hour. That's $8. Plus raw materials of $4 a unit. That's a total of 12. So if they charge $15, that's $3 gain for each unit divided through. We have 40,000 units, and the price would give us 600,000. Let's do another one at 18. Here it'd be $6 gain per unit, now with 20,000 units. But notice the revenue times 18 is 360. Notice it's not linear. Well, last but not least is foreign exchange. Let's open 2 accounts. The home account, say in dollars, and to be whatever fraction of the year the interest rate at home in dollars. And we're going to multiply if it's per foreign currency per dollar, so it cancels, and that's in the future at time t. That should equal the foreign account, same time period, same multiplication, but that's done in the present. Because think about it, the money must have left earlier to be overseas, just as the American money at home is converted later. And you set the 2 equal. It's called the interest rate parity theorem. First example, U.S. return is 12%. In the U.K. it's 4%. British pound is currently worth $1.50 in American dollars per 1 pound. What would be the 90-day future? Well, notice that's a quarter of a year. So thus we'll use 3% in the U.S., 1% in the U.K., and so in 1 year's time we'll have $1.54.5, and in the UK 1 pound and 1 pence, if you will. And we take the ratio of the 2. What's on the denominator? We're doing this per pound, so we divide by the pounds, and we get just about $1.53. Notice that 3 cents is a 2% difference between the 2. And here's a trick. Make sure the viewpoint, here it's per pound, well, the rate is lower, thus its currency should rise going the other way. Here's a very different one. The Swiss franc is 80 cents in the US dollars. 90-day future is 81.6 cents. The US return is 8%. What's the Swiss return? Well, notice it went up 2%. It's 2% difference. Turns out it would be 0.